Welcome, everybody. This is our May edition of the Policy Research Talk series. As many of you know, these talks give us the opportunity to present work coming out of the research department, and in this case with some of our collaborators, with the goal of sharing the findings within our own department, across departments within the World Bank, as well as with others outside of the World Bank itself. I'd like to welcome our online audience on WebEx and the live stream, as well as our in-person audience. Thank you for coming. Today I'm really pleased to introduce our speakers, Oyebola Okunogbe, Pierre Bachas, who are two researchers in the Development Research Group, along with Anne Brockmeyer, who is with the Macroeconomics Trade and Investment Team of the Equitable Growth Finance and Institutions Vice Presidency. I promised myself I wouldn't use any acronyms today, so I'm spelling everything out. Our three speakers will be presenting a work related to the topic of taxation for development. And for those who don't know, actually all three papers were featured in a recent issue of the Journal of Economic Perspectives. So we're getting a personal presentation of some very high-profile work. Oyebola is an economist in the Human Development Team of the Research Department, whose research focuses on governance and political economy, including policies related to public finance, nation building, education, employment, and gender. Pierre is an economist on the Macroeconomics and Growth Team, whose research focuses on public finance in developing countries, in particular optimal tax design and challenges to tax collection, resulting from tax evasion, informality, and differences in economic structure. And Brockmeyer is a senior economist and the global lead for tax data analytics at the World Bank. Her research lies at the intersection of public economics and development economics, with a focus on tax system design. I'm also really happy to welcome today our discussant, who's Manuela Francisco. Manuela is the Global Director for the Macroeconomics Trade and Investment Global Practice in the Equitable Growth Finance and Institutions Practice Group, soon to be renamed Prosperity. It'll actually be less of a mouthful. It's a position she started on the 1st of January 2023. Manuela joined the World Bank in 2005 as a country economist in the Africa Department. She's since held various positions, including a Director of Credit Risk in the Chief Risk Officer Vice Presidency. And before that, she was a practice manager for MTI, and I already spelled that out previously, in the South Asia region. Before joining the bank, Manuela was an assistant professor at the Universidade de Minho in Portugal. She holds a PhD in economics, international macroeconomics from the University of Nottingham. I'll start by asking Oyebola, Pierre, and Anne to talk for about collectively 45 minutes, and then we'll hear from Manuela for 10 minutes or so. And we'll conclude the session with a Q&A with the audience, both in person and online. If you have a question online, please use the raised hand feature, or just signal in the chat that you have a question, and I'll call on you. Just a reminder, we are recording the online version of this. And also, if you're not speaking online, please do mute your microphone. With that, over to you, presenters.
Thank you very much, Dion. And thank you all for being here. It's such a pleasure to have this room filled with everyone, and also for everyone that we have joining us online. Today, I'm going to be talking on a subject that is of great interest to policymakers, to international organizations like the World Bank, and to researchers alike. And this is the question: how can lower income countries collect more taxes? And we'll be focusing on the role of technology, tax agents, and politics. There's a little bit of a noise.
Yeah, if you're online, please can you make sure that you're muted? I see there's one person who's not muted. Also, we'll follow up in the room.
Sorry, it was my hair.
Oh, okay.
Okay, so this is joint with Gabe Turek, who's University of Pittsburgh. So the starting point for the talk today is that We all know that taxes are important for development. So governments need tax revenues to invest in public goods, to provide public infrastructure, to invest in human capital, to provide social protection. The needs are endless. At the same time, we know that there are, at the moment, low-income countries tend to not collect enough taxes. So low-income countries collect about 10–12% of GDP in taxation revenues on average, compared to about 30% in higher income countries. And one thing to note is that this is very similar position to where today's high income countries were a century ago. So on the right map, we have 18 high income countries and their progression over time. And we find this relationship, which suggests that perhaps tax capacity is a byproduct of economic growth. We examined the data for this, and we do not find evidence to support this. In fact, what we find is that if you look on the x-axis, this is the change in the economic growth, change in GDP per capita over 30 years from 1990 to about 2020. And on the x-axis is the change in tax to GDP of countries. This relationship is pretty much flat. All this suggests that countries actually do need to make these intentional investments in their tax capacity if they want to increase their level of tax collection. Another thing to note is that the tax rates and policies that lower income countries have on paper are very similar to what higher income countries have. And so the fact that we see these gaps in collection suggests that there is an important role for administration, meaning the ability to actually implement the policies that are on the books. And today, we're going to be discussing 3 dimensions of tax capacity that governments need to invest in if they want to increase tax collection. The first one is what I'm referring to as identification capacity. And this is meaning that governments need to be able to identify the tax-based and taxable entities. And this is by no means trivial, because if you take a place like Africa, for example, where 45% of people do not have a government-issued ID, they are not known to the states. If a state in that kind of setting wants to collect taxes, the first point of call is actually increasing your knowledge of who your tax base is. Next, we have detection capacity, which is the ability to verify the amounts that are owed. What is the true tax liability? And many times governments address this by collecting information from third parties that they can now use to cross-check what the individual is declaring to them. And third is that beyond knowing what is owed, governments need to be able to collect these revenues into the state coffers. There need to be ways of, on the one hand, facilitating people to pay, so making it easy and lowering compliance costs, but then on the other hand, to bring the force of the law on people who do not wish to comply. And so these 3, identification, detection, and collection, are themes that we'll come back to. For the paper today, we're going to be highlighting lessons from evidence in the literature over the last decade or so on interventions to increase tax capacity and what we've learned about governments being able to collect more revenues. And the first pillar that we'll examine is technology. Technology, as in every other facet of life, has delivered very powerful tools, which I'll show you have created a lot of potential for identification, detection, and collection. Next, we move to the role of tax officials, because technology is a tool. It has to be used by someone. And tax officials are the key element of tax administrations. And we'll be looking at specifically the way in which they're deployed and the ways in which they're incentivized and how this affects their performance. What I'm going to argue is that we have enough evidence of very effective interventions on the use of technology and the deployment of tax officials, which leads to the question of why don't we see more of this? And for that, we'll turn to the third point, which is politics. And the argument is that political incentives at the end of the day are what determine the level of investments that states are going to pursue in these different elements of tax capacity. The level to which a government believes that it needs taxes and the costs and benefits of pursuing taxation are going to eventually shape the tax investments. So moving to the first point, which is on technology. There are now quite a wide variety of tools that governments can use in increasing tax capacity. So starting from identification, now it's possible to have things like biometric IDs to identify citizens, and even things like property databases that are all geocoded for easy tracking. On the detection side, there's a There are new tools which are very exciting. For instance, things like electronic fiscal devices, which are installed in stores and retail stores, and as soon as they're checking out customers, that data is immediately sent to the tax authority so that they know exactly what the revenues are. We also have things like electronic payments through credit card or mobile money that provide, again, a paper trail of the transactions that are occurring with a firm. We have things like electronic invoicing that are used for the VAT. So it's very useful in cross-checking the reports of a transaction between a seller and a buyer. And Anne is going to describe this more. We also have electronic systems for data transfer across countries that can be used to track offshore wealth. And Pierre is going to discuss more about monitoring evasion across countries. On the collection side, there are many tools now, like electronic tax transactions, for instance, like electronic filing and payment, that all serve this facilitation tool to make paying taxes easier. I went through this very quickly because I covered some of this in the previous PRT that I did in 2021, and I also have references to papers that go more in depth. So while we do have a number of studies now that show in very nice, rigorously identified settings, the impact of technology on revenues, it's nice to also see this across countries. So here we have a relationship between the use of technology in a country. So this is a digitalization survey conducted by the OECD in 2023, where they ask countries all the different types of technologies that they have. And we can see that this positively correlates with tax revenues as a share of GDP, even when you control for the income level of countries. So this is just nice data to see on the aggregate. And now once I would just like to emphasize on the use of technology is that it's not enough for countries to adopt a nice technological system, and we have these new databases. There needs to be complementary actions that are taken to actually maximize the use of it. So to take one example, the benefits for many of these electronic systems is that a lot of high quality tax data is generated in the process. But what we find is that this is often underutilized in many low-income countries, perhaps due to lack of skills. That's a major thing, but there might be other constraints. And so being able to systematically use this data for detection and for enforcement is really important. And in the absence of this, we've seen studies where a lot of money is left on the table. And so one example of the ways it can be used is to be able to use it to inform a risk-based audit system to direct enforcement efforts. A second important practice is that governments need to realize that taxpayers are smart. You know, time after time again, you find that once the government comes in one direction to, for instance, get more information on the revenues, taxpayers are very strategic and then they adjust on another margin. So if the government knows that I'm collecting more revenues, then I remember that I have all these expenses that I also need to add onto my tax declaration. And so being able to close loopholes and have a comprehensive view of the financial situation of firms is important. And third, which I would probably emphasize the most, is that technology is not going to all of a sudden solve all the tax enforcement problems. Instead, it's a tool that must be coupled with the traditional enforcement. I'll refer to a project that I did with the Liberia Revenue Authority in Monrovia, where they invested in creating a new property database, and so collecting all this information on where properties were located, who the owners were, and then we had a randomized experiment where we sent out these notices to people with this detection information to let them know that the government knows who you are and knows that you've not paid your taxes. And what we find is that that information on its own does not actually move compliance behavior. The only thing that moves it is when it's coupled with information on penalties and enforcement as well. And so technology on its own, it has to be in a framework of the traditional legal enforcement tools. Now I'm moving to the next component, which is the tax officials. So tax officials, what we see is that they're a core input to tax capacity. So in this graph, I have on the x-axis the population per staff. This is from the International Survey and Revenue Administration. And what we find is that there are a lot more staff per population in higher income countries and higher tax collecting countries. So for instance, in the United Kingdom, you have one tax official for about every 1,000 citizens. And this is an order of magnitude higher, like 1 per 10,000 in a place like Ghana. And not only do they have more staff, but they also use them differently. So they tend to more of people in higher income countries are assigned to things like audits and investigations compared to lower income countries. Beyond the numbers and incentives, we also see things along the deployment and incentives of these tax officials. So we find, for instance, in the case of Indonesia, that being able to assign more staff to higher tax bases, so from things like medium tax offices and large tax offices, that actually increased revenue collection by about 50%. We also have studies showing that prioritizing enforcement are the areas with the highest likelihood of yielding revenues, and showing another paper on the assignment of teams, so pairing high capacity team members together, that also, in a cost neutral way, increases the amount of taxes that are collected. And now moving on to the incentives, we have evidence, both of these case papers actually from Pakistan, showing that either financial incentives or even non-financial incentives, like having a choice of where you're posted to, led to higher performance by tax officials. And so in this too, thinking about technology and human tax agents, a key task is really balancing the strength of both when in lower income countries as they start to adopt more tech-based systems. So for example, we know that technology-based systems, it creates this standardized interface for everyone, it processes massive amount of tax data, but then the downside is that it might also disadvantage certain taxpayers, those that are lower income, lower education, that have more difficulty accessing the system. On the side of the tax officials, we find that from this, a lot of in-person interactions that they have, they actually gain a lot of rich contextual knowledge of the tax base that could be lost if in the transition to online systems. And so being able to balance this advantage that they have with the risk of collusion and bias and extortion that could come from these interactions is an important process that countries need to go through. In thinking about the interventions that I've described so far, one thing we do in the paper is we study papers that have been published since 2011 and look at a range of interventions that have increased tax collection substantially. So we have 39 interventions, 26 studies, a wide range of countries, and this is what we have. So these are the different categories that I've just described, with the incentives of tax officials, their deployment, identification, capacity, detection, collection, capacity specifically in the facilitation arm, as well as the enforcement. And there are two main takeaways from this table. And one is that there's now a lot of evidence on things that work, that increase tax collection quite substantially. So for instance, we look around the middle row of third-party detection, we see several studies that are yielding 30, 40, 50% increases in tax revenues. And the darker shaded colors are showing that this is happening on a very high base. So the bases here are over $100,000 US. And so these translate to pretty substantial increases. Second thing to note is that some of the areas where we're seeing the biggest increases also seem to be around the officials of the tax incentives, the incentives of tax officials, and the enforcement. And so this is really going back to the point I was making earlier, that we have seen a lot of interventions that can yield increases, and so why don't we see more of this? And this leads to the role of politics. And the fact is that politicians might rationally be unwilling to tax, because taxation can very easily have a political cost. And so, for instance, we've seen evidence that asking citizens to pay taxes increases their level of political engagement. In fact, we see cross-country evidence that when competitive elections are approaching, governments actually reduce their tax collection effort. And so one thing to really understand is, what are the factors that shape the willingness of governments to pursue taxation? And we, in the paper, go over three main things, which is the availability of alternative revenue sources, the level of political competition, as well as the available technologies that can reduce the salience of collection of taxes. And this is a case study of Lagos, Nigeria, that really illustrates these different points I just mentioned. So this was in the early 2000s. There was, in Lagos, the governor was from the opposition party, and there was a lot of political competition between Lagos and the central government. And what we have is that at that time, there was a dispute about local government. And so the federal government cut off the monthly oil revenue allocation to these local governments in Lagos State. So the tap that was flowing all of a sudden dries up. And what we find is that even though we can already see an upward trend before that happens, this ramps up significantly when there is no longer the oil money flowing. And so the question is, how did the government achieve this? There's a lot of papers in the political science literature that actually study this in depth, and some of the things they point to are investments in technology as well as investments in personnel, and how a lot of these were things that the government did to ramp up this tax collection. One, I was living in Lagos actually right in 2006, and so it was so salient. Everything was pay your tax, pay your tax. At the same time, there was a lot of public good provision that was happening. That, roads were clean, and it's like, yay, this is what your tax money is doing. And so it really was, to me, a very visual experience in seeing how this works in practice. Now, going forward, I think there's a very large research agenda ahead, but a few things to highlight are things around understanding these complementarities between tax technology and tax officials, and how we can harness even the new tools like in AI and other changes like digital currencies, and being able to really stay at the forefront of this. And second is really thinking carefully about how to build broad-based political support for strengthening taxation. And on the World Bank side specifically, we are very excited that we have a new initiative to work in harnessing electronic tax data that countries are producing using all the new technology investments that they've been making over time. And this is such a rich source of, and Anne is going to go more into this in a very good example of what this data enables us to do, but in thinking about policy questions that can be answered. And as I mentioned, countries that own this data many times underutilize them. And so one of the things we're very excited about is also to be able to partner with countries in providing technical support and trainings and providing code and documentation for how they can utilize such data on their own. So thank you all again for your attention and for being here. I'll hand it over to Anne, who's online.
Thanks, Oyebola. Anne, are you there? We saw you earlier, but there you are. Okay, great.
Great. Thanks so much, everybody, for joining. Thank you, Dion, and thank you, Manuela, for discussing our work. I'm really excited to present to you our paper on the value added of value-added taxes. So this is joint work with a great team of co-authors, Julia, Vedant, Mazar, and Miguel. And it was really a collaboration across several institutions. So between the World Bank, the Tax Dev Center, which is the Center for Tax Analysis in Developing Countries, co-delivered by ODI and the Institute for Fiscal Studies, and ICTD, the International Center for Tax and Development. And most importantly, we had a superb collaboration with revenue authorities in the 11 countries that we study, so we're super grateful for that. And for those connected online, Vedant, my co-author, is also happy to answer any questions that you may have in the chat. He has delved more deeply than any of us in the team into the VAT data and the VAT systems with our partner countries. He can, for instance, say terms like VAT withholding in 5 different languages. So he's great, and you can ask him all the hard questions. So the VAT is arguably the single most important tax in lower income countries. And it's also the fiscal tool that governments often turn to first in a time of crisis. It raises a lot, about a third of total tax revenue, and also has potential to further increase. The VAT, or rather the textbook model of the VAT, has 2 important features that can make it an attractive policy tool. The first of these features is what we call production efficiency. So the fact that the VAT does not distort input prices and firms' production decisions. The second feature is that the VAT is revenue efficient because it has this inbuilt structure that makes it hard to evade and hence allows it to collect a lot of revenue. This is because firms report both their VAT liable sales and also their VAT liable purchases to the government. And so for each transaction, the government gets two reports, one from the seller and one from the buyer, and these two reports can be cross-checked. So the VAT lends itself very well to the digital enforcement technologies that Oyebola has just mentioned. Now, despite these attractive features, the performance of the VAT is often thought to fall short of the policy's potential, and especially in lower income countries. So let's look at the C efficiency, which is an imperfect but commonly used metric for VAT efficiency. It's basically VAT revenue over the tax rate times consumption. So asking how much could you potentially be collecting if all consumption was taxed? And the C efficiency is generally quite far away from 100% and is lower in lower income countries. Now, this is an aggregate metric. It doesn't necessarily tell us how VAT systems work in detail and how they can be improved. So to shed more light at how VAT systems function, we assembled microdata, meaning firm level VAT data from 11 countries at different income levels, ranging from $500 per capita in Ethiopia to $45,000 per capita in France. And we then use these data to establish 4 novel stylized facts on VAT systems. And using this type of data as part of a broader agenda using microtext data from a diverse set of countries to study important development questions. So we have another paper with Pierre, for instance, and co-authors where we study in a group of 15 countries effective corporate tax rates and the global minimum tax. And we have another related paper with Pablo Garriga and co-authors where we use the tax data to study the effect of COVID on firms. So in this paper, we document through the 4 facts how real-world VAT systems diverge from the textbook ideal of the ideal textbook model of the tax. Now, many governments or some governments have in the last couple of years have toyed with the idea of replacing the VAT. So in the end of the paper, we then consider alternative tax instruments and show that they actually could not do better than the real world VAT systems, imperfect as they are. So getting rid of the VAT is not the answer. Instead, improving the VAT is the answer. And the World Bank and our partners at TaxDev and ICTD, we're here to support countries in their endeavor to improving their VAT systems. So now let's delve into the 4 facts, starting with fact number 1, which is about the concentration of VAT revenue. So in the textbook theory of the VAT, one attractive feature of the tax is that it is broad-based, remitted in small chunks along the entire value chain, so by many firms throughout the economy. In practice, however, we find that VAT collections are extremely concentrated, with the largest 10% remitting about 90% of VAT revenue, and the share is even larger in the lower income countries. As a result, tax authorities have to spend quite a lot of time dealing with small businesses that ultimately account for little revenue, and the small businesses have to spend hours trying to comply with the VAT. Now, the tax practitioners wouldn't be surprised by the fact that tax collections are generally so skewed towards bigger firms, but the level of concentration and this negative correlation with development are facts that we hadn't previously documented, and it's really the newly available microdata in a diverse set of countries that allows us to establish this point. Fact number 2 relates to effective tax rates. So the ideal textbook VAT avoids distortions to production by imposing the same VAT rate on all goods and services. In practice, however, VAT systems diverge from this ideal. So exemptions and reduced rates are common, with often problematic implications for equity and efficiency. So here, using microdata, we can show that the selling goods that are reduced rated or exempt from VAT is actually more common among larger firms, and the sales of these goods are also larger for larger firms. And because of that, effective VAT rates end up being lower for the sales of larger firms compared to the sales of smaller firms. And larger firms are typically also those who are catering more to the richer customers. Now, this result holds true even within small industry bins. Now, this is all focusing on the formal sector. Once you consider informality, that adds an additional layer of complexity, and Pierre is going to discuss that in more detail. Moving on to fact 3, we're looking here at non-reclaiming of input VAT. So the fact that firms remit VAT on their output, but can deduct VAT on the VAT that they paid on their inputs, that's also a defining feature of VAT system, and is also necessary to ensure that the VAT is production efficient. However, it is actually common for small firms to not claim any input VAT. So in the countries we study, almost 50% of the smallest firms, so those in the 5% in the bottom 5% of the sales distribution, those firms do not claim any input VAT. And overall, the share of firms not claiming input VAT is higher in lower income countries. Again, this holds within industry bins. And when firms do not claim any input VAT, despite using taxable inputs, then the VAT chains are broken, and this introduces distortions and limits also the revenue efficiency of the tax. Our last fact relates to VAT refunds. So refunds help underpin the destination principle of the VAT, so the fact that the tax is ultimately levied where the good or service is consumed. And so this requires that exports are zero rated, which means that exporters often generate refund requests. Now, refunds are a critical part of VAT systems. In higher income countries, for instance, about 30 to 50% of VAT revenue ends up being refunded back to taxpayers. But in lower income countries, VAT refunds are constrained by government's limited administrative capacity, the risk of fraud, so firms submitting kind of fraudulent refund claims, and sometimes also government's reluctance to actually forego revenues. And this means that firms often wait for months and months, if not years, to receive VAT refunds. The time to receive a refund is, again, strongly negatively correlated with a country's development level. Now, long refund delays have serious implications for businesses' cash flows. And although most countries try to facilitate refunds for exporters, because exporters are most likely to generate large refunds, these facilitation strategies seem to be insufficient, because in our countries, in the data that we study, exporters are actually not less likely to generate refunds than other firms. Now, given all these imperfections of real-world VAT systems, should countries consider replacing the VAT by alternative tax instruments, such as, for instance, a retail sales tax or a turnover tax that may be simpler to collect? Now, this sounds a bit potentially crazy, but it's actually been policy questions that have been debated and discussed in recent years in, for instance, Ghana, Malaysia, and Zambia. So what we do is to simulate how these alternative tax instruments would work, focusing on the case of Pakistan, which is one of the countries where we have very detailed transaction level data that allows us to simulate these other taxes. So in Pakistan, actual VAT revenue before COVID was about 1,500 billion rupees. Now, the data allows us to tag business to consumer sales, so we can then ask how much revenue would be collected by a retail sales tax, so a tax that is only levied on the sales of retail firms. Now, in theory, a retail sales tax is the same as a VAT. The difference is just that the VAT is levied in small chunks along the value chain, but the retail sales tax is entirely remitted by the retail firms without any input credit mechanism. This sounds kind of simpler, and there's fewer firms to deal with for the tax administration. But in most lower income countries, as in Pakistan also, retailers are much smaller firms and less tax compliant than upstream firms, say manufacturers. And so a retail sales tax, even if levied at the same rate as the VAT, so 17%, would collect less than a third of the revenue that the VAT collects. So that doesn't really seem to be a viable option. Now, alternatively, the government may say, okay, let's collect the tax from all firms along the value chain, but let's just get rid of the input tax credits. That's complicated. Let's just make it a turnover tax. So it's just a tax on the total sales of all firms, no input tax credit. Sounds also simpler, right? So here, what we can do in our data is to calculate what would be the rate at which the turnover tax has to be applied to collect the same revenue as the VAT, holding everything else constant. Now that counterfactual turnover tax rate is 6.1%. So that's a very high, very distortionary rate, because this turnover tax itself is distortionary as it cascades through the value chain. Now, as the turnover tax is distortionary, firms' output with such a high turnover tax rate might actually go down. So it's quite possible that the government couldn't even collect as much revenue as it can with the VAT using a turnover tax. So in conclusion, real-world VAT systems diverge substantially from the textbook model, but the VAT is ultimately irreplaceable. So how can countries improve their VATs? Well, they can reduce exemptions and reduce rates, especially if those have little equity benefit or even make the tax system regressive. And also facilitate refunds using the technologies that Oyebola has just discussed. Governments can also task larger firms or digital intermediaries with withholding the VAT from smaller firms and thereby improving their compliance and potentially lowering compliance costs. But ultimately, we need more analysis to better understand the puzzling compliance behavior among small firms that may be simultaneously kind of evading taxes, but also leaving money on the table by not claiming input tax credits. And we need more work on optimizing the use of tax data for enforcement and facilitation, taking into account also spillover effects in networks. And in general, I think our paper suggests that there's a lot we can learn from microdata, but also a lot we still need to learn to better understand tax systems and their equity and efficiency implications. And these microdata, which are now becoming more and more available, allow us to shed light also at other important dimensions of the development process, such as, for instance, firm growth and labor market dynamics. And so this is why we're all really excited to be soon launching DayTax as a lab to study taxes, firms, and jobs using microtax data. And DayTax would be a collaboration between FE, DEC, and other parts of the bank that work in this space, and together also with external partners such as the Tax Dev Center and the EU Tax Observatory, and of course, most importantly, working with ministries of finance and tax administrations around the world. So stay tuned, and thank you so much for joining today.
Thank you, Anne. I'm amazed that the DayTax folk managed to get the Tau in there. That's so nerdy. Okay, over to you, Pierre.
Thank you, Dion. So thanks, Anne and Oyebola. This was really interesting. Ryan, the slides are not showing yet. So this last talk is on the dimension of tax equity, right? We saw administration, we saw efficiency of the key instrument, and now we're going to talk about the distributional part of taxation. So first, we're in a context, as we know, a lot of governments are feeling a lot of fiscal pressure, but at the same time, there's a very high income concentration that has actually, if anything, worsened in the last 20 years. And we know that this needs to be addressed multidimensionally. On market income side, we need active labor market policies, skills building. We need also targeted transfers and flexible social insurance program. But we also need a third leg, which is progressive and fair taxation. And by progressive tax, I'm going to think of having higher tax rates on those who are able to pay more. So this presentation is based on the third article in the Journal of Economic Perspective called Tax Equity in Low and Middle Income Countries, which is co-authored with Lucy Gaden and Anders Jensen, plus some other ongoing work. So the first thing we do in this paper is just set a framework of what is tax incidence, who is actually paying taxes. There's three key ingredients that someone needs to know to think of tax incidence. The first one is the easy one. What's the statutory incidence? If we have the tax laws, we can go and check what are the rates, what are the base rules, and so on. The second one that's harder is the de facto incidence. In practice, in a context where you have a lot of tax evasion, informality, avoidance, who really pays the taxes could be very different from who the law intended should be paying the tax. For a long time, this had been overlooked, in part because there was this optimistic assumption that maybe this was not first order for high-income countries. In the last 10, 20 years, a lot of work has tried to correct this. And just to give you a sense, these are graphs you probably know, but the size of the informal sector, we can take a proxy self-employment as a proxy of labor informality. And you can see here how large it is and how it relates with the country GDP per capita. And on the right-hand side panel, you have a more novel measure, which is consumption informality, where we proxy this with the share of consumption occurring in the traditional sector, small stores, self-productions, and the likes. So once we take, these facts into account, we know that de facto incidence is going to matter for equity too. The third piece is arguably the hardest, and that's somewhere where we need a lot more work, which is economic incidence. Market prices are going to respond to any tax, potentially shifting the burden away from those who are paying the tax with those who are trading with them. An example, for example, comes from the sales tax. A sales tax is remitted by a firm, but very often is passed on to consumers in the form of higher prices. And so, while that had been an active literature in OECD countries, it's more recent that we see some paper in low and middle income countries. For example, the work of our colleague Dario Tortarolo. Where is he? I saw him earlier. So the second chapter then think of, given the current tax revenue and tax mix of developing countries, what is the likely incidence of these taxes, in particular those first two factors, right? The statutory and the de facto incidence. I call this a tale of two taxes because really with two main instruments, you have most of the tax revenue in developing countries. On the one side, we have indirect taxes, of which by far the main component is the VAT. And on the other hand, we have the personal income taxes. In developing countries, indirect taxes are about 60% of tax revenue. I've excluded social security from here. While the personal income tax is around 10 to 15% of tax revenue. And the real big shift that we observe across development is that the personal income tax starts taking off, but at relatively high income levels, right? After 15, 20,000 in GDP per capita. For rich countries, eventually the personal income tax represents about half of tax revenue and really displaces indirect taxes. So what is the progressivity of the PIT in developing countries? So first, let's start with what we've just seen, which is that developing countries are characterized with a large share of activity in the informal sector, a high reliance on indirect taxation, and low levels of personal income tax collection. So this does not bode very well when we think of equity, right, at baseline. Now, maybe the low PIT is still very progressive. If it's all borne by the very top, maybe that's fine. We still have progressivity in the tax system. So in work we've done with colleagues in the poverty group, Matt Waipoy and Mariano Sosa, we try to get the de facto distributional incidence of direct taxes based on individual, about 100 CEQ country studies. And so here, when we compare high-income countries to developing countries, you see again that level point, right? The high-income country at all deciles of the income distribution lies above. But more importantly, you see the gap in progressivity. Right? So let's compare, for example, the top decile of high-income countries relative to the bottom decile. This is a gap in average tax rate of around 15 percentage points in high-income countries, and you can see it's only 5 or 6 percentage points in developing countries. Right? So much less progressivity is brought from this relatively weak personal income tax. So optimal taxation, in this context with constrained income taxes is kind of a newer problem for the literature because if we look at the textbook policy, it would say all redistribution should be achieved with the income tax and some transfers. In practice, we see that when you have such a weak income tax, you might still care about equity and think of other instruments to alleviate, the lack of tax progressivity. In practice, what we see that many countries actually do rely, for example, on the VAT and indirect taxes for equity purposes too. A very, ubiquitous policy is to have zero rate or reduced rate on necessity goods. Think of food, think of medicine and other products. Sometimes also higher rates on luxury items. So how should we think of introducing progressivity, behind this kind of bleak picture I've just described? And I think that, there is cause for a lot of hope and progress in the next decade. Here we might want to separate, I think, countries in two groups. In middle-income countries, we can do a lot more to strengthen the personal income tax. And I'm going to finish talking about this. In lower income countries, it's probably hard to do a lot with income tax due to some real information issues. You know, Oyebola had discussed the enforcement problem. There's still two types of decisions that still matter a lot for equity. The first one is just tax administration, something we rarely think about for equity, but it actually matters potentially a lot. We dedicate a whole chapter in the paper with examples coming from property taxation. Property taxation, if done well, should be quite a progressive tax. We know that real estate is concentrated at the top, typically. But for example, in a paper in Senegal, Knebelman, Poulican, and Sarr find that when it was left to discretion, this ended up being kind of a neutral tax in terms of progressivity because of where the agents would choose to enforce how they value property. Upon much better automation in property tax valuation, that improved a lot the progressivity of the property tax. The third element is that when your income tax is constrained, you really want to think of the design of the VAT and of indirect taxes. And so I'm going to show you a few examples of how that matters. So this is work from another paper with Lucy Gadden and Anders Jensen, where we've taken household surveys in about 33 countries, and we've plotted the informal budget share as a function of a household's income. So let's take the example of Mexico. What this is showing you is that for a household in the bottom decile, almost 60% of their consumption occurs in those traditional stores or from self-production. When you go to the top decile, this falls to around 20%. Okay, so very different distributional patterns in the way household shops, right, consume, which can have important consequences for equity. So what does that mean? First, consumption taxes, once you take into account the informal sector, are more progressive than often considered. Now, how much more progressive? We estimate around a drop of 1 percentage point of Gini, a 2 percentage drop. It's not nothing, it's not huge either, right? The personal income tax in rich countries, it's about a 7 or 8 percentage points drop in Gini as a comparison. The second one, and maybe more relevant for policy, is that the policy of having low tax rate on necessity goods is not introducing a lot of progressivity once we consider the informal sector. These exemptions benefit mainly people who consume in formal stores, who tend to be the rich. And so there's a key policy challenge, which is how to phase those exemptions out in a societally acceptable way, and I think some of the work of people of the bank is going this way. The third one, even more specific, is that non-standard indirect tax policies could be desirable for equity. For example, India has had for a long time ration shops, which is these are subsidized price for fixed quantity of basic goods. And so Gadden shows that this raises welfare and acts as insurance in India. In some recent work with Davi Bering and Pula Ghosh, we're looking at also higher rate on luxury items. In the case of India, we show that, as expected, those are quite progressive, but also not very distortionary, actually, which is maybe more surprising. And as I already mentioned, we need more evidence on the economic incidence of indirect taxes. In Mexico, for example, when we look at a VAT hike, we find that consumer prices in the formal sector respond by about 75 or 80%, so they raise by quite a bit. But note that prices in the informal sector also increase, right? So thinking about kind of the supply chain effects, competition, and so on, right? And so we need more work that thinks of the interaction, for example, between the formal and the informal sector. So the last part I want to talk about, a more positive view, which is I think a lot can be done in these coming decades towards a progressive income tax in a lot of countries, and especially in middle-income countries. Because improving, tax equity will require more than just a better designed VAT, property taxes, and targeted enforcement. We will need progressive income taxes and some taxation of capital income. Now, traditionally, observing the income of the rich and that of large firms, of multinationals, has been challenging. There's a few big issues. The first one is offshore income and wealth. The second one is that a lot of the rich and the very wealthy hold income in corporations. And the lines between labor and capital income can become very blurred. You can consume within the firm, use assets of the firm to obtain loans, decide on the timing of realization of income, all things that the tax administration would have difficulty dealing with. And finally, for a long time, corporate taxes were quite high in the 70s and the 80s and would act as a backstop for the personal income tax. Even if personal income tax was low, you would collect it from the firms. Potential as a backstop of the corporate tax has really been eroded via tax competition and aggressive profit shifting in the last 2 or 3 decades. I want to show you some work we've done with the EU Tax Observatory as part of the Atlas of the Offshore World. Those are a set of maps that are trying to put numbers on tax avoidance and tax evasion. Here I'm showing you, for example, a map of how much financial wealth is held abroad for each country. The world average is around 12 to 13%. This is a large number, right, of money held abroad. This does not have to always correspond to tax evasion, but even in countries like Denmark or Norway, we estimate that only about 20 to 25% is reported domestically, right? So that doesn't bode well, I think, for other countries. You can see that Africa is particularly affected with around 18% of its GDP held abroad, but so is Latin America with around 14%. Another map is how much missing profits there are. Those are profits, profit shifting, profits booked in tax havens and not in the country where really the activity is happening. The world average there is around 10 to 11% of corporate income tax missing globally. And again, with countries in Latin America particularly affected there. The policy response of the past 2 decades has been inadequate. It's been to lower taxes on mobile basis, kind of more tax competition, if you will, lower taxes on capital income, top earners, and replace those with payroll and indirect taxes, hurting equity in the process. The second type of policy has to be to limit rate differential across tax types, thus limiting the progressivity of the entire tax system. So think of the flat tax rate in a lot of Eastern European or Central Asian countries, right? Low flat tax rates. And so what then has meant that even in rich countries, at the very top, and here I really want to highlight that we are at the very, very top. We're talking about 100 millionaires or billionaires, right? The effective tax rate paid by individuals has fallen. And this is when we use this comprehensive measure of income that is also the income that is held within firms, the undistributed profits of firms that are linked and attributed to individuals. And we can see that here we have a real program of equity. Even in countries that have quite high tax rates like France and the Netherlands, the billionaires end up paying only about half as much taxes as the rest of the population. This is the type of exercise we can increasingly do by merging with shareholder or beneficial ownership data individuals and the corporations they directly control. So we, for example, with Thiago Scott, Tatiana Flores, Santiago Cesteros, and Gabriel Kelly of the World Bank, we've tried to do the same type of exercise in Honduras, for example. And so here you can see the first point to the left is that at the very top, all income is basically in undistributed corporate profits. In the case of Honduras, the drop is only at the very, very top and maybe not as spectacular as the one we saw in France and Honduras, in part because the corporate income tax stays relatively high in Honduras. But we think this is really the type of work we need to repeat in other countries to get a really good distributional picture of income taxation. And so I want to finish with 2 messages. The first one is a lot of people would think, well, taxing capital, taxing the rich, that's really bad for innovation. But one thing we see repeatedly is not just that the average tax is low, is that there's very large dispersions in the tax rate paid by the rich and paid by the very large multinationals. Within an income group, if you want, within a size bin of firms, some firms are paying almost 0 tax rate, while others are paying the full legal statutory tax rate. This cannot be good for efficiency or competition, right? So that's something we think important to keep in mind. The second one is there's cause for some cautious optimism because of what's been called the ABC of taxation, of international taxation. The A stands for automatic exchange of financial information. The days of bank secrecy, where you could put money in a Swiss bank account, those are really over, and that's good news. This is quite recent, and a lot of developing countries haven't made most of what they could do by exploiting such data for audits. The second is that beneficial ownership registries that link individuals to the firm they control are being implemented or are actually active now in a majority of countries. And the third is since this year, January of 2024, there's a corporate minimum tax of 15%. It's a global agreement. We're going to see how it actually plays out, but this would now put a floor on how much profit shifting could occur globally. Yet governments are going to need assistance in this fast-changing environment, to track the evolution of these comprehensive top incomes, to use the new data to reduce evasion and avoidance at the top, but also for advice on the tax policy. For example, all the tax incentives that exist are now going to be impacted by the corporate minimum tax. And so this, you know, you've probably tired of hearing of day tax. We hope to do this as part of the day tax agenda with Anne, Oyebola, and many other colleagues in this room. And we'll also be selling merchandise at the exit door. We have some hats, no? And so I'll leave it here. Thanks a lot for attending this talk.
Thanks, Pierre. I mean, that was a fascinating collection of stylized facts, policies, programs, and reflections. Wow, amazing collection of 3 presentations. Over to you, Manuela, for some reactions and reflections.
Thank you. And where is, I just move it here?
Ah, yes.
Okay. Okay, yeah, I can do that. Okay, let's see. No? Yeah, here it is. Okay. Good afternoon, everyone, and good evening for some that are connected. I want to thank you for inviting me to be here today. I was very impressed with the work that was presented by Oyebola, Anne, and Pierre. Your work is very valuable to us in operations, and I hope we will continue working together, because I think you have very relevant work for the work we do directly with the clients. So I will talk more about how I see the work you are doing and how that can help us in dealing with, when we deal directly with clients. What are we doing in the regions and the center, because actually the department I lead is a center that then supports the regions, and how we can work together. So, as you know, we have been working on domestic resource mobilization for decades. I joined the bank in 2005, and we were working on domestic resource mobilization. I did the PR in 2005 or 2006. So why are we elevating this agenda? Why are we talking so much about DRM? So as you know, as part of the evolution roadmap, DRM is one of the key components. So the evolution roadmap has 3 parts, basically. One is that we need to optimize the financial models of the World Bank, so then we can squeeze out more money for development. Second is that we need to bring in the private sector, because public money is not enough. And third is domestic resource mobilization. There is the realization that the client countries, that's how we call them in operations, need to do their share. There is not enough taxpayers' money and contributions from ODA. There is not enough interest on the private sector to finance development. And just to give you some numbers. So, as you know, and you have these numbers yourselves, 78% of low-income countries and 56% of LMICs collect then 15%. Tax revenue to GDP below 15%. As you know, as per the literature, a country to fully function and to provide service delivery in adequate manner should collect at least 15%. More than 50% of the low-income countries are at high risk of debt distress or in debt distress already. And they are in this situation because they run large fiscal deficits for a long, long time. We have done an analysis why countries are in such a difficult position when it comes to debt, and it was because they didn't consolidate on the spending side and they didn't collect enough on the revenue side. Just to give you another data point, because this is very important, I think, this year, in 2004, low-income countries will need to make debt repayment in the amount of $175 billion. This is mostly domestic debt domestic debt. This amount is equivalent to 7.5% of the combined GDP of low-income countries. On average, the low-income countries spend less in education, health, and infrastructure than 7.5%. So this is actually compromising future growth. We also did an analysis, and we saw that the countries right now face a situation of net outflows, meaning that they are paying more debt service that they're actually receiving financing. In addition to all this, there is climate change. And they need to invest in adaptation, and we estimate that it will be about 1.85% of GDP annually until 2030. When we look at all the data, when we look at the external financing needs, we reached the conclusion that it will be about $820 billion from 2024 to 2028. And this is in a context where the global financial markets remain tight, where we are hoping for advanced economies to start loosening monetary policy, which is not happening. Inflation, as you know, the pace of disinflation has slowed down, so there is lots of uncertainty about monetary policy. And these countries need to raise this much money. So this is the context. So this is why DRM is so important. And that's why your research is so important. So countries will need to do a big effort on their side to collect more, to have better tax systems. So let me tell now a bit, I mean, a lot of this has been said, but I just want to summarize. Low-income countries face many challenges. One, because there is lots of informality. Many countries are heavily independent on extractive. As you know, many countries didn't negotiate the royalties with the large oil companies in a good way, so they are actually quite losers. There are weak tax policy frameworks, large tax exemptions, there are lots of elite capture in these countries, and there is very limited capacity on the tax admin side. We heard a lot about PIT, but I just wanted to say that it has a very limited role in low-income countries. First, because the income is low across the distribution. So that is a challenge. And above all, perhaps the most important point is because these economies are poor. So if you have a poor economy, no matter how much you do, how well designed is the tax system, there is a limit how much you can collect. So we are very encouraged by the research that you have done and that was presented here today, and we really hope that we can collaborate and use your wisdom as we advise policymakers. So to tell you a bit about what we are working and how we would like to work together and where you can help us. So let me tell you what we are doing. As part of the evolution roadmap, DRM became front and center, as I said. In the past, we used to do public expenditure reviews. You probably have seen them. You may have even contributed to some of them. We used to prepare one every CPF cycle for either countries. That was the requirement. Right now, the requirement is that we have to prepare a public finance review, which will include expenditure analysis and revenue analysis in every report. Plus, we need to prepare this for IDA countries and IBRD countries. We have developed tools, templates, analytics, and data so that the teams in the regions can quickly prepare these reports, because we also need to give them to the ministers of financing in a timely manner. Otherwise, they are irrelevant for the policymakers. We have some pilots where we are basically experimenting and see how we are doing with these templates, with the tools and the analytics. I actually encourage you all to go to the dashboard and type PFR, and you'll see tools, analytics, papers, data. It's a very rich data set, database. The country partnership framework we succeeded in including a provision in policy that will require that every country that has a tax revenue to GDP below 15% will need to include a discussion on the RM on the CPF. As you know, the CPF is the guiding document for for working with the government officials. Basically lays out the country assistance strategy, the assistance strategy with the client. The hope is that if we discuss that in the guiding document, then projects and analytics will follow. Pilots. So we have been working on DRM for such a long time with very mixed results. I myself seen country reversing many policies that we decide that we need to try to do things differently. So we are doing these pilots with IMF, where the World Bank and the IMF will bring everything we have together, and we will go on mission together, and we will have joint assessments, joint reports. We will have, we'll speak with one voice on what we think the countries should do, and we hope to move the needle in a sustainable way. So we have identified 5 pilots: Paraguay, Cote d'Ivoire, Nigeria, Egypt, and Bangladesh. In these countries, we will work very closely together. I should say this goes beyond DRM. We are also going to be working on domestic capital mobilization. So we are trying to capture public money. We are trying to increase public money by taxing more or better, but we are also trying to mobilize private sector money. Scorecard. If you heard our president, this is very important. So we used to have over 200 indicators. There were so many that no one really paid attention. But now there will be 22 results indicator that will be closely monitored by senior management. And one of them is the RM. Everyone is going to be looking into this. So it's very important. We count on your support. And of course, we provide, we write papers many times in collaboration with you. We do technical assistance, we develop tools, and there are a number of things that we have ready available in the center to support the regions. I would just want to talk briefly about political economy, even though Oyebola talked about that. Tax reforms are politically very sensitive. Actually, when we had some discussions at the board on the RM, I've heard from some constituencies that is a sovereign issue. We should not talk about taxes. Well, we've been talking about taxes all the time, but you know, lots of people would rather if we would stay silent, because we will cause some noise and we may upset some people. The truth is, if we do not find some vested interest, if we don't create some noise, we will never be able to move the needle and have impact on the RM. And there are some encouraging cases. So for example, Kenya, they were about to have a liquidity cliff, and they managed to avoid it because they started to implement some reforms. Angola implemented the full subsidy reform. Ghana, as you know, they had the domestic debt restructuring. They are in the process of external debt restructuring, and they are implementing reforms already. Nigeria, they eliminated full subsidies. They came back. It's a bit of a, well, they come back, but anyway, it's a bit difficult. But they have also done some DRM reforms. I didn't put here, but Egypt is another case. But I wanted to say 2 more things on this point. One is that we are talking a lot about DRM, but Oyebola showed an important fact when you said that advanced economies were collecting as much as the low-income economies are collecting now 100 years ago. What happened between these 100 years? They grew. So we can think about the most fantastic reforms. If the economies do not grow, we will not achieve results. So we cannot neglect growth reforms to complement tax reforms. And finally, When we think about development, we can never, in my view, we can never focus on revenues only, because how you spend it matters as much as how much resources you collect. If you collect resources and they go into waste, into some white elephants in terms of infrastructure, if they don't go into productive use, if they are not going to fuel growth of the future, in the end, you will not achieve your objectives. So it's very important to always look on the expenditure side too. So in our team, very briefly, we are working on cost effectiveness of tax incentives, particularly in VAT. We are broadening the base of the VAT systems. We are doing some reforms on PIT, but we are also looking to personal income taxes. If we want to talk about progressivity, typically income taxes are paid by the wealthiest. So even if you change on the margin, is going to be progressive. And property taxes, which are very important as well, but you need a number of reforms, namely fiscal cadastres, valuation systems. Actually, Anne talked about Pakistan a lot. I worked on Pakistan. And actually, we started some reforms in the area of fiscal cadastre and valuation. So it was not in all provinces, but in some provinces, land was not, they were not collecting taxes on land. And the result was that the land stayed idle. No one was using that land for a productive use because there were no opportunity cost on that land. So there are two problems. Is that one, you do not collect, and typically these are to support local government. Second, there is no opportunity cost, so you just leave land without any use and without making a productive use of it. And we are also working on tax administration reform. That is an agenda more for our colleagues in governance. So I just want to conclude with the collaboration with DEC. So we are already doing some work together, notably in Nigeria, potentially Zimbabwe and others. The microdata that we heard about today, I think, can be quite helpful for us as we support the regions. The DataX Lab is something we are very proud of. And it's a joint effort, and we think we can really take that far, and I think can be very, very helpful as we continue our support to the countries. And yes, with this, let me conclude. Thank you so much.
Thanks, Manuela. That was amazing that even the discussant ended with the day tax plug. That's pretty wild. Well, thank you. That was great reflections on the content, on the collaboration, on the synergies between the research and the operations. Just on the issue of land, actually, just to give another plug, which is at the land conference that's coming up very soon, we'll be doing a launch of a report that with the research group we're doing in collaboration with the Africa Chief Economist Office, where this issue of land registration and linked to taxation is highlighted, and a really salient aspect of land policy in sub-Saharan Africa. One other thing I wanted to compliment you on was not only did the reflections really useful, you actually made the evolution roadmap sound fairly clear and straightforward. So that's kind of the first time I've seen that. Okay, so without further ado, for the presenters, are there any immediate reactions you might have to the discussant? And otherwise, we can just open it up for general questions. If you're online, again, just raise your hand or put something in the chat that you'd like to ask a question. Maybe we'll start from within the room. Just raise your hand until I get a sense of how many. We have one, Norman, there. For now, we just have one. Okay, Norman, go ahead.
Thank you. Well, first of all, congratulations. I think it's wonderful research and very well presented. I do have a challenge for all you guys, and this is to write another set of papers where the emphasis is taxation for growth. Because we have seen lots of interesting presentations here on how to tax more, how to make the VAT more efficient in the same regard, and also taxation for equity. But there is this other aspect that I believe is at least as important, and this is taxation so that you can increase the base, you can have less informality, and you can actually have more growth. And you know all the benefits that come with growth, of course. And one of those benefits might actually be you will be able to collect more tax revenues. So you can then complete the circle. Thanks.
Thanks, Norman. Anybody else in the room with a question or reflection? Oh, there. Go ahead.
So maybe this is an opportunity to make a plug. I think the one takeaway I have on the presentations, and then I'll link it to the question that was just asked, is that traditionally it's often assumed that there is a trade-off between efficiency and equity. And I think a very important message that's coming out from the analysis of tax administration and other data that Pierre, Anne, Oyebola, and other colleagues have been making is that this is not always the case. In fact, efficiency improvements can be progressive. So, for example, the point that they make on VAT exemptions is that we find that most VAT exemptions are captured actually by the larger businesses and benefit the higher income deciles, means by definition that if you take this away and you use this VAT even in a universal cash transfer, which is another paper, we find the result is more progressivity. So you're both improving efficiency and you're improving equity in the same time. You're supporting growth and you're supporting the inclusivity of this growth. So that's, I think that's an important takeaway for me that when I see this work. And the plug is we're attempting to start to get into this space, but we fully agree that this is a knowledge gap. We have a PFR pilot that Manuela mentioned in Georgia. It's going for decision review tomorrow morning. So please don't kill us. But in that tax chapter, we look at informality, tax efficiency, and growth. And we have some policy recommendations on how you can basically change the tax mix and reform some tax exemptions to basically reduce informality, and we show with a CGE model that will boost productivity and growth. So have a look at that, but that's only the tip of the iceberg. We need to do a lot more.
Thanks. I want to give a chance to the presenters or the discussant if they want to react to these comments. Do you have a... Okay, go ahead.
Thank you, Norman. I think it's a good point, but I agree with what Jafar said to some extent, right? And I tried to say it in the last slide, which is it's not obvious these days that there's always so much tension between the goal of efficiency and equity. In the sense that, you know, for example, the work we've done with Anne on effective tax rate of firms, you observe that even within the very large firms, you have huge gaps in the effective tax rate. There's a lot of firms who are literally paying zero, and then there's firms who are abiding, you know, by a 30% tax rate, for example. It's really hard to think, you know, in which world this is an efficient policy to have, you know, firm-specific tax rates, basically, which is what has happened in a lot of Latin American countries, for example, via, you know, special economic zones that were supposed to be for exporters, but when you look, a lot of these firms are not exporting anything, and the likes, right? So, you know, currently, I think we really need to be thinking of closing a lot of the loopholes, which, you know, are inefficient. They lead to a lot of rent seeking, you know, optimization. I mentioned, you know, you transform your capital income into labor income and vice versa. You know, a lot of things that are actually costly for the firms in terms of accounting. And then, you know, if you've done that, then you can think of how do you, sorry, right. So, could you please close your microphone online?
Hi, the person who's speaking, can you please, Alexandra, could you please mute? Thank you.
Thank you. And you know, if you have achieved that, then there is a question, how do you recycle the revenue? Can you even lower some of the tax rates? The real risk is that if you don't do that, you're going to have to increase taxes on payroll, for example, or on consumption, right? Which they're also very distortive. And on top of that, they hit more, you know, the median earner or even poor earners. So.
Sorry, quick 200. Pierre, I hope that you are not dismissing the research agenda on taxation and growth, because what you just said is that with one slide, you're summarizing whatever we need to know about taxation and growth, and I don't think that's true.
No, and I agree with you. We can think of a lot of, policies, but I think right now we're starting from way too many incentives that are very badly targeted, right? And so that doesn't mean there's not a big role of taxes for growth, but I think thinking of this matters a lot, right? And so that can give you almost a double dividend, I think. Once you've plugged some of this, I agree with you, and I think when we're thinking of the transition, right, towards a greener economy, we're going to need to think a lot of, how the tax system works and so on. So I agree with you, Norman, sorry. Didn't mean that, but I'm not sure that, a lot of people always put these two, efficiency and equity, in contradiction. I'm not sure that's necessarily always the case, right?
So, Oyebola and Anne, any other reactions? So, okay, so I have a couple questions. So to Oyebola, I wanted to come back to what I thought was an odd contrast, but then Manuela kind of picked up on it as well, which is the sort of historical trajectory of tax to GDP rates, which immediately, you anticipated the way we would interpret that is, as countries grew or as incomes get higher, then the tax to GDP rate goes up. So countries today are just like these other countries were 100 years ago. But then the next slide, you showed that there's basically no association between GDP per capita or I guess it was GDP per capita growth. Okay. So anyway, so maybe the simple version of the question, is it true that low-income countries today are just like the rich countries today were when they were low income or middle income? Is that statement sort of about right?
Yes, so I think the income levels, they're very similar in that regard. The main takeaway from there is that I completely agree with Manuela's point about growth is essential. That's like, you have to start from there. But it's not automatic that once you have higher incomes, then your tax collections will just automatically also take off. Because you find many places where there's economic growth, but there aren't these complementary investments in actually harnessing this growth and converting that into the revenue collection, which can then be reinvested. And so I think that's the main point there, is that you can have the economic growth without actually increasing your revenues. And we also find reversals where some countries actually were collecting, I was reviewing something for Indonesia recently. They were collecting pretty high, like a decade, 2 decades ago, and now really dropped. And so there are lots of things that happen which can be quite parallel to the growth trajectory of the country.
I guess I had another. Thank you. That's clarifying. For Anne, I hope you're still there. Yes, there you are. I guess one of the phrasings you used was that alternatives are not viable, and I guess I just want to come back to that term viable. In a sense, I thought what you showed us is that maybe they're not as effective, or they're not as efficient, or they're more expensive. But I'm kind of curious why you use the term viable. Is that they're not sustainable, or what? How are you thinking? What were you thinking of when you used the term viable? Sorry.
Thanks. It's a good question. So I guess I was thinking of viable within the current budgetary framework of those countries, because it seems that the retail sales tax would make the current kind of fiscal expenditure predictions of the countries not viable, because it would just collect so much less tax. And the turnover tax similarly would probably collect much less revenue and also be very distortionary to growth. So to Norman's challenge, then I think the turnover taxes, is definitely something to that countries need to stay away from when they want to have both strong governments that can ensure pro-poor expenditures, but also support the development and growth of the economy more generally. And maybe just to add a comment on Norman's challenge, which is a good one. So I think in the DATEX program, we would have a whole work stream on production efficiency, which is basically about kind of relieving constraints to growth, constraints to resource allocation. thinking about how tax policy, whether and how tax policy should support the green transition would also hopefully become part of that. Because with tax incentives for the green transition kind of proliferating, there is kind of the race to the bottom in green tax incentives, or the race in green tax incentives. And I also just want to mention that there's already quite a bit of ongoing work on formalization and design of tax systems for small firms. So for instance, Chris Hoy, Jonathan Carver, and Thiago Scott are working on that in Georgia, Kenya, and Tanzania, also connected with the PFL work that Jafar was mentioning. So we hope soon also to have new insights on how to encourage the transition of these small firms into the formal sector.
Thanks. Actually, that relates to a last question I had for Pierre, which is sort of this notion of informality. And the way you almost presented it like it was either an explicit or an explicit exemption. And you sort of incorporate that into your assessment of progressivity. But is that really sustainable? I mean, sure, as a sort of a snapshot one time, okay, but should a country be thinking of that as a policy per se that they want to actually treat explicitly?
Thanks, Dion. That's a very good question. So first, I think coming back, indeed, without growth and well-targeted expenditure, like a lot of what we've been talking about is not that interesting, right? In the sense that you don't probably want to collect much more revenue if it's all wasted and in a context where, the country is going backwards in a way, right? So that I think we all agree upon. Maybe we didn't make it clear enough. And so I think that's going to link to your question in the sense that should we think of the informal sector, its size as something structural, that there's not a whole lot you can do about it, or is that a parameter in and of itself? Increasingly, and I think some of the research, for example, by David McKinsey and others, have shown that it's not easy, just with small incentives, and so on, to register a lot of firms. And not is it obvious that you actually want to do so. What you really want is firms to select basically into formality, because there's some advantage eventually when they become big enough. For example, you get better credit access, you get potentially other advantages. And so that's probably, the link to growth again should be made here, is that as you get bigger, you're going to want to select anyways into the formal sector. At least that's my view and my reading of the literature. When you think of some of the smaller firms, you could do some specific intervention. It's probably not going to be very long-lasting and long-lived. And so my view is to see this as something a little bit more structural. We can play with it, at the margin, but I tend to think that, if there's a lot of traditional or shops or self-production, that is quite structural to the economy, and there's not a whole lot maybe policy can do.
Okay, great. Well, we've come to the end of our time. Did you have any closing reactions you'd like to have, Manuel?
Just on this point of taxation for growth. For me, everything is for growth. So taxation should be for growth, expenditure policy should be towards promoting growth, debt policy should be towards sustainable growth. So if not for growth, for what, right? No, but in my view, if you want to have equity and distribution, you need to grow.
That's ignoring the trade-offs. There are trade-offs.
There might be trade-offs, but if you don't grow, you don't achieve much. So that is the base. So everything is to promote growth. So what I really think it's important to design policies that support economic growth the same way expenditure, as I said. But at times there is a bit of a confusion when you speak about taxation for growth. People may interpret, in some countries, this could be interpreted as tax incentives that would allow to attract some companies into a country because of tax breaks, tax credits, or tax exemptions. At times, creates that confusion, and we don't want that confusion.
Okay, well, thank you, everybody. Please join me in thanking the presenters, our discussant, for a really fascinating session.